Today, we're going to pull back the curtain on one of the most profound and yet misunderstood transformations in the history of money. It's the story of how the very definition of what money is was fundamentally changed. And here's the kicker. This wasn't some secret plot. This was debated in parliaments, it was passed into law, and it was sold to everyone as a guarantee of financial stability. We're going to explore how that legal process quietly reshaped our entire world.
So let's start with this question because it really gets to the heart of what we're looking at. We're going to dive into the historical record, no theories, just the facts, to understand how a system that some critics today call a fraud became the absolute bedrock of modern finance. We're going to trace the seemingly small steps that led to a monumental shift.
All right, to really grasp how big of a deal this change was, we have to go back in time. We need to visit the world that existed before all this. A world where money wasn't just a number on a screen, but a real, physical thing with its own value. You see, for centuries, money's value was obvious. A gold coin was valuable not because a king said so, but because gold itself was rare, durable, and everyone wanted it. Simple, right? Economists call this commodity money. Your wealth was literally what you could hold in your hands. But as you can imagine, trying to keep large amounts of gold and silver safe was a huge problem, and it forced people to look for a better way. And that search for security became absolutely desperate in 1638. Before then, if you were a wealthy merchant in London, the safest place to store your gold was the Royal Mint, protected by the king himself. But King Charles I was broke and needed money for a war. So he did the unthinkable. He walked into his own mint and seized all the private gold stored there. He called it a forced loan, but the damage was done. Nobody trusted the crown to protect their wealth anymore. A new solution had to be found, and fast. So this crisis of trust actually led to one of the most important financial innovations in history. With the Royal Mint totally compromised, merchants turned to London's goldsmiths. I mean, these guys already had secure vaults to protect their own gold and silver. And this simple business of renting out that vault space, well, it set the stage for a practice that would literally redefine money itself. At first, when you deposited your gold, you got a simple receipt for your specific coins. It was basically a coat check ticket for your money. But pretty soon, the goldsmiths made a subtle but revolutionary change. Instead of a receipt for your gold, they started issuing notes that promised to pay a certain amount of gold to the bearer, that is, whoever was holding the piece of paper. These notes were way easier to trade with than heavy coins, and they started circulating as if they were money. And that's the critical shift, from money as an object to money as a promise, an IOU. And here's where the goldsmiths had their big aha moment. They noticed that most of the gold they were storing just sat there. People rarely came to withdraw it all at once. So they thought, hey, this is a business opportunity. They started lending out a portion, a fraction of the gold they were supposed to be guarding. Think about it. A merchant deposits 100 gold coins. He gets a paper note for 100 coins that he spends in town. Meanwhile, the goldsmith lends out 90 of those actual coins to someone else. All of a sudden, two different people have a claim to the same gold. The money supply wasn't just the gold anymore. It was the gold plus all the paper promises floating around. This was the birth of fractional reserve banking. Now, this practice started to spread, but it was informal, controversial, and operated in a legal gray area for a long, long time. Then, in the 1840s, a huge debate in the British Parliament brought the whole thing into the spotlight. And in their attempt to settle the argument once and for all, lawmakers accidentally cemented this new form of money into law. The debate basically pitted two big ideas against each other. On one side, you had the currency school. These guys were really suspicious of the goldsmith's trick. They wanted hard money. They insisted that for every single paper note out there, there had to be an equal amount of gold sitting in a vault. It was the only way they thought to prevent financial chaos. But on the other side, you had the banking school. They argued for more flexibility. They thought banks should be able to create credit to fund businesses and help the economy grow, and that the market would keep everything in check. Well, the currency school won the argument, or at least they thought they did. The Prime Minister, Robert Peel, pushed through the Bank Charter Act of 1844. This law was designed to kill fractional reserve banking for good. It gave the Bank of England the sole power to issue new notes, and, this is the important part, it required every new note to be 100% backed by gold. The goal was to put the genie back in the bottle. And you have to understand how this was presented to the public. It wasn't advertised as some revolutionary new system. It was sold as a conservative move, a return to the safety and stability of good old-fashioned hard money. The promise was simple, an end to the financial panics that had been causing so much trouble. But, and this is the pivot point of the whole story, the creators of the 1844 Act made a colossal mistake. They were so focused on regulating physical paper banknotes that they completely forgot about the other kind of money that had been evolving, bank deposits, the kind of money you move around with a check. The law put a chokehold on creating new paper notes, but it left the creation of deposit money, literally just writing numbers in a ledger, completely untouched. So what happened? The financial system, of course, just adapted. The banks simply changed their business model. Instead of creating unbacked paper notes, they started creating unbacked bank deposits. And this quiet shift, made possible by that one legal loophole, unleashed consequences that would define our economy for the next 200 years. The result, what you could call the Great Divergence. On the one hand, you have the amount of physical gold in the vaults, which is pretty stable. You can only mine so much of it. But on the other hand, you have the total money supply, all the paper notes and digital bank deposits claiming that gold, and it just began to explode, growing exponentially. The link between real physical value and the amount of money in the world had been broken. And this new system has some really profound consequences baked right into its design. First, since new money is created every time a loan is made, the money supply is pretty much always expanding. That leads to a slow, steady loss of your money's buying power. We call that inflation. Second, for the system to even function, it needs more and more debt to be created all the time. It's a feedback loop. And finally, when you can create credit so easily, it can fuel wild speculation, leading to massive asset bubbles and, you guessed it, financial crises.
Now, like any system, this new financial order didn't treat everybody equally. There was a very clear set of winners and losers.
Here's how it breaks down. Governments found it way easier to finance their spending and rack up huge debts in a system where money was always expanding. The banking sector, well, they were the ones creating the new credit, and they profited by earning interest on money they literally created out of thin air. But the primary cost? That fell on savers and regular wage earners. That built-in inflation acts like a hidden tax, silently eating away at the value of your savings and your paycheck year after year. So you might be sitting there thinking, okay, that's some interesting history, but what's it got to do with me? Well, everything. That clever little trick the goldsmiths came up with in the 1600s is the fundamental operating system of your bank account right now, today. And look, this isn't some conspiracy theory. The Bank of England itself, the institution at the absolute center of this whole story, has stated it plainly. The old idea we learned in school that banks take in deposits and then lend them out, that's wrong. It's the other way around. Bank lending creates deposits. When a bank gives you a loan for a house, it doesn't take someone else's savings. It creates brand new digital money in your account. In our modern world, the act of lending is the act of money creation.
Once you understand this, so much about the modern financial world just clicks into place. It explains the timeless appeal of gold and silver, assets that exist completely outside of this credit system. And it gives you the crucial context for why something like Bitcoin was even invented in the first place. It was a direct technological response, designed from the ground up to be a form of money with a fixed, predictable supply that couldn't be expanded forever.
So we come full circle. The modern money system wasn't born from an illegal conspiracy. The Bank Charter Act of 1844 was public law, passed with the stated goal of making things more stable. The problem was never its legality. The problem was its profound and, for a long time, hidden consequences.
And all of this history leaves us with a really fundamental question for today. The system we have allows for incredible flexibility and credit-fueled economic growth. But the price we pay is constant inflation, ever-expanding debt, and the boom and bust cycles that come with it. Knowing the full nature of that trade-off, a cost that was hidden from view back in 1844, would we, or maybe should we, make the same choice today?